Hello everyone, my name is Moji. You're watching a Bitcoin bubble news channel. The rate at which banks give money is not very high at all. Very low interest rates on bank loans around the world. Even though the rise in their money supply is still pretty slow, it is mostly because the government is running deficits and the central bank is helping to turn those deficits into cash. It's not likely that higher interest rates will have much of an effect because the government won't change how much it spends based on what the central bank does, unlike how the private sector does. Because of this, I believe it's useful to know where the money is coming from and what tools can slow down or not slow down the process. Lyn Alden is here today to help you get ready for old age by telling you what assets you should buy and how to get ready for it. Lyn also tells us what she thinks will happen with crypto in 2024. Let's watch the movie right away. That is correct. If we talk about different times, I think it will help make the case clearer. Because of this, many people think of the 1970s when they hear the word inflation. It was very expensive to live in the 1970s. Most of that was inflation caused by banks lending money. So there are two main ways that new broad money gets into circulation. One is loans by fractional reserve banks. The other one is budget deficits that are paid for with money. So you can also measure how big what's going on there is. In other words, they had deficits in the 1970s. The amount of new loans made by banks each year, on the other hand, was bigger than the size of the budget deficits that year. This is especially true when you look at it over, say, 5 years. In other words, banks are giving money, which means more money is coming in. There are many reasons for this, but the main one is that the baby boomers were getting ready to buy their first homes. There was a big increase in the number of people. And a lot of them were at the peak of building credit. People could also buy homes earlier because they were cheaper back then. Most of the time they bought them in their 20s or early 30s, but they could start buying homes younger than most people do now. So this big generation is entering the years when they buy homes and start families. This is also the time when banks are giving out the most loans, money is being created very quickly, and prices are going up because of this. This is because of the higher than usual rate of money creation at the same time that oil supplies are obviously limited, and we also have some background deficits that weren't helping even though they were smaller. And Paul Volcker, the head of the Fed, raised interest rates to the highest level they've ever been in the US to get that under control. The federal government only had a 30% debt to GDP, which made that idea work. This meant that neither the state sector nor the private sector had a lot of debt, but he was still able to raise rates very high. In turn, that made people take longer to decide to borrow money. Someone who wants to borrow money at a rate that is much higher than the rate of inflation might not want to do so. Thus, real rates are really high, both when compared to different types of inflation measures and when used on their own. Because of this, people are less likely to want or be able to take money, and banks are offering less loans. When credit shrank, it pushed the economy into a kind of decline. But you take some of that growth out of the system, you lower demand just enough to let supply catch up. We can see that monetary power is at work there, which is also what causes inflation. And then what was done about the high prices. The 1940s were another time of high inflation in the US, and when most people think of inflation, they don't think of that decade. But on average, it was just as high as the 1970s. But that was the last time we had the most money. That's why banks didn't give much in the 1940s. That wasn't a time when banks were lending money quickly. Instead, it was clear that the setting was World War II. In this way, they had already been through the famine. The big private debt bubble had already burst, and they began moving more of that debt to the public sheet. They were stuck in a time of inaction for a while, but then war broke out as populism spread around the world, in part because of the economy. There were also huge budget deficits during the war, the largest deficits ever seen in relation to GDP. These events were even bigger than the ones in the 2020s. Many of those funds are used to fight the war, but they are also used for things like developing commodities and making things. You help pay for the GI's college and trade school and their mortgage when they get back to the United States. It's mostly government spending projects, right on, yes, a really big boost in many ways. These were a lot of bonds that they released to pay for everything. The Federal Reserve bought a lot of them, which increased their monetary base. After that, they were bought by commercial banks using fractional reserve debt. There was a huge increase in the money supply, but it wasn't because banks were lending. Instead, it was because the government was running huge deficits that were paid for with money. And the Federal Reserve was pretty much taken over by the Treasury. Even though inflation was very high, They kept rates low because raising rates wouldn't change Washington's mind. It doesn't matter what the Fed does, they're still going to fight this war. That won't be changed at all. So, it's a whole different set of tools for that. In the end, after the war, they turned more toward economy, and they had a lot of good things going for them to get through that. In that case, though, economic dominance is pretty much at its worst. Mickey traders are asking if GameStop 2.0 is coming after Gil's sudden return. A lot of people think he was to blame for the 2021 GameStop short squeeze. Some experts aren't sure, but most are optimistic. Gil was in charge of the GameStop case during COVID-19. Traders on Reddit bet against hedge funders who were shorting a physical game shop because they thought it would fail. This made GameStop stock worth more than 1,000% more in just 1 month. Some say that after the GameStop short squeeze, Dogecoin and Shabbat went up a lot. While stores sold other things, on May 13, 2022, Anis Gil went back to social media after being away for almost 3 years. The last thing he wrote was on June 19, 2021. As usual, he shared a mysterious picture of a player sitting up straight and looking at the PPI data to let everyone know he was back. This week, financial expert Tet Talk Macro found a strange setup. The PPI came out before the CPI. It's a strange situation for traders because it doesn't take into account data-related random misses. He told people who follow XF that the PPI and CPI numbers are strongly linked, and that the BPI numbers came out before the CPI numbers. He also said that statistics from the US VPKI was made public before CPI. The FedWatch tool from the CME Group says that the market will respond more strongly to bad news. This shows how big events can change the way people think about a Fed rate cut before September. At the June meeting of the Federal Open Market Committee, the odds go down by 25 basis points. At the July meeting, the odds go up to 24.6% with ANC. Not only did they give the banks cash, but they also gave them stability. The other part was money. What little fiscal help there was for the rest of the economy was pretty small. Among other things, there was cash for clunkers. I remember this. That was a scheme run by the government that let you buy a used car. Is that what it was? Yes, it gave people a reason to trade in their old cars for better ones. It was meant to help them out while also helping the industry. But that is so small compared to what we've seen in the last few years that it's pretty funny. Also, I guess they gave seniors a little boost. It was like a small stimulus check. People who were jobless got a little more money and benefits than usual. A small amount of economic support was given to the edges, but most of it went to the banks to help them get back on their feet. And then there was a huge amount of money. Another way to say this is what is the fiscal support relative to, for example, a lot of loans went bad between 2008 and 2009, which means they were not paid back. Also, one of the few real ways to mess up the money system is to not pay back a loan or pay it back and not renew it. There are ways to do those things quickly or slowly. Cut down on the amount of money in circulation. So during that time, the money supply would have gone down a little because people didn't pay back their loans. The amount of money they gave was about the same as the amount of loans that were not paid back and the amount of giving that slowed down. In order to keep things in balance, they made sure that there was neither depression nor really low inflation. Deflation is what they call it when prices drop below what they used to be worth. But it wasn't like a huge thing that was much bigger than the bills that were being distributed.